Beloved listeners, as we find ourselves at the crossroads of life, with retirement on the horizon, or perhaps already in view, there's a fundamental question that everyone faces. What will happen to your money after retirement? You've worked your entire life, carefully saving and investing to build a nest egg. But how do you ensure that nest egg continues to grow, even after you've stopped working? The thought of living off your savings for the rest of your days can be daunting. But I promise you, it doesn't have to be. The greatest gift you can give yourself in retirement is peace of mind, the certainty that your money will work for you. But here's the catch. If you keep your money parked in low-interest savings accounts, or you leave it under your mattress, you will see your wealth slowly erode away, consumed by inflation and rising costs. This is not the future you've worked so hard for. This is where we begin. How to invest your money wisely after retirement, so that you can preserve and grow your wealth. The right decisions can provide a steady stream of income, while also protecting your hard-earned assets from inflation and market volatility. It's not as complicated as you might think, but it does require understanding, discipline, and a long-term vision. Now, let me ask you a question. What if there was a way to make your money work harder for you? Imagine that every dollar you've saved continues to earn returns, even as you step into the golden years of your life. Imagine feeling secure, knowing that your financial future is taken care of. The key to making that vision a reality is understanding the principles of investing after retirement. And today, that's exactly what we're going to uncover. We will explore the best ways to invest for high returns, no matter what stage of retirement you're in. And I promise it's not about taking unnecessary risks. It's about understanding the opportunities that exist and making calculated decisions based on knowledge and wisdom. So, as we dive into this journey, remember one thing: your wealth should never be passive. You've worked hard for it, now let it work for you. Now that we've set the stage for understanding the importance of making your money work for you after retirement, let's take a deep dive into what that actually means. The first and most important thing to recognize is that our preserving capital is just as crucial as growing it. At retirement age, you no longer have the luxury of time to recover from losses. You need your money to be secure, predictable, and consistent. For this reason, the foundation of any successful post-retirement portfolio should include income-generating assets. You need investments that will produce reliable returns, or as with a lower level of risky than the volatility of the stock market. Let's start by discussing Azar's bonds. Bonds are often considered a safe and predictable investment. When you buy a bond, you're essentially lending money to a government or corporation in exchange for regular interest payments. This is a great option for retirees who need regular cash flow. Many retirees lean on municipal bondsy or corporate bondsy because they provide fixed interest payments, which can serve as a dependable income stream. But not all bonds are created equal. Some are riskier than others, and they can be affected by interest rate changes. For instance, if the Federal Reserve raises interest rates, the value of bonds may decrease. So it's important to be selective. Haas government bonds or high-grade corporate bonds tend to be the safest, but they offer lower returns. If you want higher returns, you may need to consider taking on a little more risk with as-junk bonds or lower-rated bonds. And here's the key: always never sacrifice safety for yield. While the allure of high returns is tempting, remember this: it's better to earn a steady, reliable income with lower returns than to risk losing your capital in the pursuit of higher returns. Bonds can be a fantastic way to provide income without the volatility of stocks, but balance them with other types of investments to avoid relying on one asset class. Next, let's talk about as dividend-paying stocks. I know, many of you may hear the word stocks and think of all the risk and uncertainty that comes with the market. But dividend-paying stocks are a completely different beast. These stocks represent companies that consistently share a portion of their profits with shareholders, usually on a quarterly basis. The beauty of dividend stocks is that they not only provide you with steady income, but they also give you exposure to the growth potential of the stock market. Look for companies with a strong dividend track record, preferably those that have increased their dividend payouts over time. These companies tend to be more stable, as they are established with a history of profitability. Think of sectors like utilities, healthcare, and consumer staples, industries that are relatively stable and less prone to extreme volatility. Easy, AT&T, Johnson & Johnson, or Coca-Cola are all prime examples of companies that pay steady dividends. These stocks provide a combination of capital appreciation and income, which makes them an ideal choice for retirees who want to enjoy growth while also generating income. It's important to remember, though, that dividend-paying stocks are still stocks, and they come with risk. While they may be less volatile than growth stocks, they can still fluctuate with the market. A balance is key. You want to build a portfolio that includes both stocks and bonds, as well as other assets, to create a diversified income stream. Lastly, let's talk about real estate investment trusts. Real estate has long been considered a reliable investment for generating income, but many retirees don't have the capital to purchase large properties on their own. This is where REITs come in. These are companies that own or finance real estate that generates income, and they pay out dividends to shareholders from the rental income or capital gains. REITs are a fantastic way to add real estate exposure to your portfolio without the hassle of property management. Plus, they provide regular income in the form of dividends. But just like any investment, there are risks involved. The real estate market can be cyclical, and the performance of REITs can be influenced by factors such as interest rates and the overall economy. Diversification is important here as well. By incorporating bonds, dividend-paying stocks, and REITs into your post-retirement portfolio, you can create a mix of stable income sources that will help you weather any market volatility. The key takeaway from this part is simple: build your retirement portfolio on a foundation of income-generating assets. There's no need to chase after high-risk, high-reward investments when what you need is stability and consistent income. By focusing on bonds, dividend-paying stocks, and REITs, you can create a reliable stream of income that will support you through the years ahead. But remember, balance is everything. Don't place all your eggs in one basket. A diversified approach to income is the bedrock of a sustainable post-retirement investment strategy. 2. Now that we've established the foundation of a strong retirement portfolio with bonds, dividend-paying stocks, and REITs, let's talk about expanding those horizons. Diversification is critical, and in today's financial landscape, retirees have more options than ever to build wealth beyond traditional assets. Alternative investments here are increasingly becoming a popular choice for retirees looking to add another layer of protection to their portfolio while boosting returns. But here's where many retirees make a mistake. They stick only to what they know: stocks, bonds, and savings accounts. They're comfortable with the familiar, and understandably so. But comfort, while comforting, can also be dangerous. In this world of low interest rates and rising inflation, relying solely on traditional assets may not provide the returns you need to keep up with the cost of living. Let me tell you something important. As alternative investments have the potential to offer better returns, lower correlation to the stock market, and help hedge against inflation. And don't be fooled. You don't need to be a hedge fund manager to get involved. With the rise of accessible online platforms, it's easier than ever to invest in alternatives. Let's start with precious metals, particularly as gold and silver. Historically, precious metals have been a hedge against inflation and a store of value during times of economic uncertainty. Think of gold as a safeguard during times when the market is volatile and fiat currency loses value. In fact, during periods of economic stress, gold has often outperformed traditional assets. Precious metals can help protect your portfolio from currency devaluation, and because they don't correlate directly with the stock market, they can provide stability during a market downturn. However, like anything, precious metals come with their own risks. The price of gold can fluctuate significantly based on geopolitical events, inflation, and changes in interest rates. But even with these fluctuations, gold has historically held its value better than almost any other asset. It's worth considering as a small but powerful portion of your retirement portfolio. The next alternative investment to consider is peer-to-peer lending. P2P lending is a relatively new concept, but it's growing rapidly. In essence, you're lending your money to individuals or small businesses in exchange for interest payments. Think of it as ours becoming the bank. Instead of earning measly interest on your savings, You can directly lend your money to others and earn potentially higher returns. Some platforms allow you to lend money in exchange for fixed term payments, while others offer shorter term options. Now, I know what you might be thinking. This sounds risky. But the beauty of P2P lending lies in diversification. You don't have to put all your money into a single loan. By spreading your money across many different loans, you can minimize your risk and still earn attractive returns. Additionally, many platforms offer built-in protections, such as loan insurance or recovery services, in case a borrower defaults. However, it's important to remember that while the returns are higher than traditional investments, P2P lending does come with risks. You're lending money to individuals or businesses with less financial history than a corporation or government, so there's always the chance of defaults. But when done thoughtfully and with due diligence, P2P lending can be a great way to generate income after retirement. Next up, we have cryptocurrency. Now, I know some of you might have already dismissed the idea of cryptocurrency. It's new, it's volatile, and it's still an emerging asset class. But hear me out. Cryptocurrency has gained enough mainstream acceptance that it's no longer something to dismiss outright. Yes, it's volatile. Yes, it's speculative. But there are ways to dip your toes in without risking your entire retirement savings. Bitcoin, Ethereum, and other major cryptocurrencies have proven their staying power. While they may not replace traditional currencies, they offer an opportunity for portfolio growth. Many retirees find that adding a small percentage of their portfolio to cryptocurrencies gives them a way to hedge against inflation and participate in a new financial paradigm. But again, a word of caution is, don't invest more than you can afford to lose. The volatility of the crypto market can be exhilarating for some and terrifying for others. But if you allocate only a small portion of your portfolio to cryptocurrencies, you can potentially capture growth without taking on too much risk. Another form of alternative investment is private equity. For those with larger retirement portfolios, private equity can be a game changer. Private equity refers to investing directly in private companies, often through venture capital or buyouts. Unlike public companies that are traded on the stock market, private companies can offer higher returns. But the risk is higher as well. Private equity investments are typically illiquid, meaning you can't easily access your money. But if you're in the position to invest for the long term, private equity offers the potential for higher than average returns. Retirees who have the means to invest in these assets often find that they can make significant gains by investing in startups or emerging companies that are on the verge of explosive growth. Incorporating alternative investments into your portfolio, however, should be done carefully. It's vital to stay within your risk tolerance and not get caught up in chasing high returns. Instead, consider these options as part of a diversified strategy that includes a combination of stable income sources and growth investments. 2. As we continue our journey to building a retirement portfolio that not only preserves capital but grows it, let's explore another important investment category: real assets. These are the types of investments that you can physically touch, see, and even use. Unlike stocks or bonds, which are intangible, real assets often provide tangible benefits, and in many cases they help to hedge against inflation. You see, in times of economic instability or market volatility, real assets tend to perform better. They can serve as a safe haven, a protection from the eroding power of inflation that often diminishes the value of cash sitting idly in a savings account. The first real asset I want to focus on is real estate. Real estate is often considered the ultimate hedge against inflation. As the cost of goods and services rises, so too do property values, especially in sought-after markets. Real estate is a multifaceted investment because it provides cash flow, appreciation potential, and tax advantages. Rental properties, in particular, offer retirees an income stream that can continue to grow over time. But let's be clear, investing in real estate is not without its challenges. Property management can be time-consuming, and owning multiple properties can require substantial effort and capital. If you choose to go the road of owning physical real estate, ensure that you're prepared to manage the properties, or that you hire a competent property manager to do it for you. If managing tenants and repairs doesn't sound appealing, real estate investment trusts can be an excellent alternative. REITs provide the opportunity to invest in real estate without the hassles of managing physical property. With REITs, you can invest in portfolios of properties, such as shopping centers, apartment buildings, and office complexes. The beauty of REITs is that they provide both diversification and liquidity, as they can be traded on the stock exchange just like stocks. The dividends paid by our REITs are often quite attractive, making them a strong income-generating investment. As precious metals, particularly golders, deserve a section of their own too. Gold has been a store of value for thousands of years. It has maintained its value through the rise and fall of civilizations, through periods of economic upheaval and financial crisis. Gold, along with other precious metals such as silver and platinum, can be a way to diversify your portfolio with tangible assets that don't rely on the health of the global economy or the stock market. As precious metals are often seen as safe havens during periods of inflation or when the market is uncertain. Much like real estate, precious metals can act as a store of wealth and preserve purchasing power over time. In fact, when you look at gold prices over long periods, you'll see that it tends to go up when inflation rises. For example, during the 1970s, when inflation was soaring, gold prices spiked. Precious metals are a great way to hedge against the devaluation of currency and protect your wealth in times of crisis. Investing in gold or silver can be done through several avenues. You can physically buy bullion or coins, but it's also possible to invest through gold ETFs, which provide exposure to gold prices without the need for physical storage. Now, let's not forget collectibles and other tangible assets. Over the years, certain collectibles have appreciated significantly in value. Art, wine, rare coins, and even vintage cars have been used as investments by savvy individuals. These items not only carry intrinsic value, but often become symbols of prestige and status, which can further enhance their desirability. But with collectibles, I have to issue a word of caution. While the potential returns can be massive, these markets can be extremely volatile. You need to be knowledgeable and have a passion for these types of assets to truly succeed. For example, art may require significant expertise to evaluate its authenticity and future value. And vintage cars, while beautiful and fascinating, can also be maintenance-heavy and prone to market fluctuations. However, if you're the type of person who enjoys the world of collectibles and has an eye for valuable pieces, it can be an exciting way to combine passion with investment. Just remember, the key to collectible investments is ensuring that you understand the market, do your due diligence, and know what you're investing in. The final real asset we should consider is farmland. Yes, farmland. While it may seem unconventional, farmland is a fantastic long-term investment. As the world's population continues to grow, the demand for food increases, and farmland becomes even more valuable. In others, farmland offers several key benefits. It appreciates over time, provides an inflation hedge, and even produces cash flow in the form of crop yields or rental income. Moreover, farmland is a resource that will never go out of demand. Investing in farmland can be done in a couple of ways. You can either buy physical land and manage it yourself, or you can invest in a farmland REITs, which allow you to invest in the agricultural sector without having to directly manage the land. Farmland has proven to be a stable, non-correlated investment over time, and it's an increasingly attractive option for retirees looking to diversify their portfolios with real, tangible assets. The key message here is that real assets are the backbone of a solid post-retirement investment strategy. Whether it's real estate, precious metals, or collectibles, these tangible assets provide the stability and security that retirees need to feel confident in their financial future. They serve as a hedge against inflation, they provide diversification, and they can generate cash flow that will last for years. As with any investment strategy, however, diversification is paramount. You don't want all your eggs in one basket. A combination of shares income, producing investments like bonds and dividend stocks, growth assets like real estate and REITs, as alternative investments like precious metals and farmland, will give you a well-rounded portfolio that is less susceptible to market fluctuations and capable of providing income throughout your retirement years. 2. Now that we've explored some of the tangible assets that can help you preserve and grow your wealth in retirement, let's dive into the concept of some diversified income streams. One of the key principles that I want to emphasize here is the importance of generating multiple income streams during retirement. While many people envision retirement as a time to slow down, it's crucial to understand that wealth doesn't simply maintain itself. It needs to be nurtured, protected, and cultivated. And in order to achieve true financial independence, relying solely on one source of income, such as a pension, Social Security, or the dividends from a single stock, is a risky proposition. So, how do we diversify income? Well, we look at a variety of different sources, each one serving a unique purpose in your portfolio. For one, dividend stocks, a consistent income generator. One of the most popular and reliable ways to generate income is through dividend-paying stocks. When you buy shares of companies that regularly pay dividends, you're essentially creating a steady stream of passive income. These companies, often well established and financially stable, share a portion of their profits with shareholders, which can be reinvested or used as income. The beauty of dividend investing lies in its compounding returns. By reinvesting dividends, you can exponentially increase your wealth over time. Over decades, this compounding effect can lead to significant wealth generation. Now, I know that as dividends aren't guaranteed. In times of economic downturn or market turbulence, even the best companies may reduce or eliminate their dividend payments. But if you choose wisely and invest in companies with a long track record of profitability and strong financials, dividends can provide a relatively safe and predictable stream of income for years to come. Right, too. Bonds, the conservative investment. Next, we have bonds, another staple of retirement portfolios. Bonds are essentially loans that you make to governments or corporations in exchange for periodic interest payments. When you invest in bonds, you're essentially lending your money to an entity for a fixed period, and in return, they pay you interest. Bonds are generally less volatile than stocks, and they can offer a steady, predictable income stream, especially when you invest in government bonds or high-quality corporate bonds. And when the bond matures, you'll receive your principal back. But, as with any investment, there's a trade-off. The return on bonds is typically lower than stocks, and the inflation risk can erode the purchasing power of the income you receive. However, bonds can play an essential role in reducing overall portfolio risk and ensuring that you have a stable income throughout retirement. 3. Annuities, a fixed income solution. For those looking for a more structured and guaranteed income stream, annuities can be a solution. Annuities are contracts with insurance companies where you provide a lump sum payment, and in return, the insurance company promises to provide a fixed income for a specified period or for the rest of your life. This immediate annuities provide an immediate income, while deferred annuities allow you to accumulate funds over time before payouts begin. There are several types of annuities, but in a retirement context, life annuities are particularly appealing because they provide income that continues for as long as you live. The key advantage here is the security that annuities provide. No matter what happens in the market, your income is guaranteed, which is especially reassuring during retirement when you no longer have the luxury of a paycheck. But let me caution you, not all annuities are created equal. Some have high fees, and others may not be as beneficial as they seem, depending on your needs. Always be sure to read the fine print and consult with a financial advisor before making such a decision. 4. Side businesses in part. Time work, the entrepreneurial spirit. While retirement is often a time to relax, it doesn't necessarily mean you should stop working altogether. Many retirees find that engaging in a side business or part-time work is both fulfilling and financially rewarding. This could take many forms. Maybe you're a skilled craftsman who can sell handmade goods online, or you've always had a knack for tutoring or teaching. Some retirees turn their hobbies into side incomes, such as photography or writing, or even start their own consulting businesses. It's not just about the extra income. It's about staying engaged, staying mentally sharp, and staying active. This can bring tremendous satisfaction and joy in addition to the financial benefits. And let's be honest, the extra income never hurts either. 5. Rental income from properties. While we touched on real estate earlier as a way to diversify with tangible assets, it's worth diving deeper into rental properties as an income-generating asset. Buying rental properties and leasing them out can be a powerful way to generate as consistent income that can support you in retirement. The beauty of rental income is that it typically provides both monthly cash flows and long-term appreciation potential. While property management can sometimes be time-consuming, it's possible to hire a property manager to handle the day-to-day operations. Many retirees find that as income-generating real estate provides the stability they need without relying solely on market-based returns. In addition to this, rental income is as inflation-resistant because rents tend to rise along with inflation, meaning your income is more likely to keep pace with the cost of living. 2. I cannot stress enough the importance of having multiple streams of income in retirement. Relying on just one source, whether it's Social Security, pensions, or just the dividends from a single stock, leaves you vulnerable. By diversifying across several different types of income sources, you ensure that your financial situation is more secure and that your wealth continues to grow even as you grow older. Diversifying your income means you're not just investing in assets, you're investing in your future security, your peace of mind, and your ability to weather any storm that might come your way. As we move deeper into the world of post-retirement investing, I want to stress something that's often overlooked in the hustle of making quick profits offers: the importance of patience and long-term thinking. In a world where instant gratification is just a click away, we've become conditioned to expect quick results, whether it's a stock soaring in value overnight or the immediate pleasure of spending a bonus check. However, in the realm of investing, patience is not just a virtue, it's a core principle. After retirement, you may find yourself drawn to more conservative, safer investments, as many people worry about running out of money. But here's the truth: always the best returns over time come from compounding, and that requires patience. When you invest in stocks, bonds, real estate, or even annuities, your wealth will likely grow slowly at first. But over time, that wealth will multiply at an accelerated pace. The longer you leave your money working for you, the more powerful compounding becomes. But to benefit from this process, you need to resist the temptation to time the market. Yes, there will be downturns. Yes, markets will have their ups and downs. But if you're in it for the long haul, you'll find that, over time, the market has historically rewarded those who remained calm and committed, rather than those who panicked and pulled out during a downturn. Let me illustrate this with a simple example. Imagine you invest in a well-diversified portfolio, a mix of stocks, bonds, and real estate. You've chosen these assets with careful consideration of your financial goals and risk tolerance. But you're not trying to time the market. Instead, you're in it for decades, steadily reinvesting any dividends or earnings. For the first few years, the growth is modest, but over the next 20 years, your portfolio might grow by 10-15% each year consistently. You'll experience volatility, but you don't panic. You continue reinvesting your returns. And as your assets grow, you start to see the power of AOR's compounding at work. What's interesting is that even during times of market turmoil, the long-term investor who has patience and discipline will often fare better than those trying to make short-term profits. Short-term investors, those who try to play the market, might see their portfolios fluctuate wildly, and many may end up losing money. But long-term investors will have far greater success in preserving and growing their wealth. This applies to everything in life, not just investments. Success doesn't happen overnight. We all want quick wins, but the real rewards come from the small, consistent efforts that accumulate over time. It's about developing the discipline to keep moving forward, no matter what obstacles you face along the way. Many retirees mistakenly believe that once they hit retirement, their wealth should be immediately accessible and ready to be spent. But it's essential to remember that wealth is not just a tool for consumption. It's also a tool for building financial freedom and independence. The key to long-term success is simple as patience, combined with a strong strategy and a willingness to stay the course. And the beauty of long-term investing is that once you've built this habit, it starts to feel effortless. You can sit back, let your wealth grow, and live a life of financial peace, knowing that your money is working for you, not the other way around. Patience is powerful. You don't need to rush. The time will pass anyway. And before you know it, that initial investment you made years ago will have compounded into something far greater than you ever imagined. 1. Here's this: patience is one of the most important virtues in investing, especially in retirement. 2. Focus on long-term growth and as their compounding returns instead of short-term wins. 3. Avoid the temptation to time the market or make impulsive decisions during market downturns. 4. As consistency is the key, reinvest dividends, stay disciplined, and let your wealth grow naturally over time. 5. Financial freedom and peace come from setting a solid plan and allowing it to work for you over the long term. Retirement is not just about resting. It's about heirs allowing your money to rest and work for you. The more patient and consistent you are with your investments, the more you'll be rewarded in the long run. As we come to the final part of this discussion, let's tie everything together. You've learned about the best places to invest your money after retirement, the importance of creating a diversified portfolio, the value of real estate, and the power of patience and consistency. Now it's time to reflect on one of the most profound, yet often overlooked truths in investing. Your investments must align with your purpose. We live in a world that is obsessed with the idea of chasing after the next big trend, the next hot stock, or the next shiny investment vehicle. It's easy to get distracted by the noise, the fads, and the promises of fast riches. But when it comes to building lasting wealth and achieving true financial freedom, as purpose-driven investing is the key. You might have heard it said that money doesn't buy happiness. But what money does buy is freedom. It buys you the ability to control your times, to pursue your passions, to live life on your own terms. But here's the catch: money alone isn't enough. It's your values, your purpose, and your vision that turn that money into something truly meaningful. When you approach investing with purpose, you stop thinking about money as an end in itself, but as a tool for creating a life that reflects your deepest values. So before you make any investment decision, ask yourself what do I want my life to look like in the next 10, 20, or 30 years? How can I use my wealth to help me live a life of purpose, fulfillment, and legacy? For example, let's say you've worked hard your entire life and are now enjoying your retirement years. You've built up a nest egg, and now you're looking for ways to ensure that money continues to grow and provide for you in the future. But rather than chasing every stock tip or flipping through investment newsletters looking for the latest hot trend, you take a step back and think about your deeper motivations. Do you want to leave a legacy for your children or grandchildren? Do you want to support a cause you believe in? Do you want to build a retirement that's comfortable, where you're free from worrying about money? Whatever your goals are, align your investments with them. When you do this, you'll find that investing becomes far more meaningful and far more rewarding. Your retirement years are not a time to just rest, but a time to reflect, to align, and to put your money to work for something bigger than yourself. For some, this may mean investing in philanthropy, creating charitable foundations, or investing in businesses that align with their values. For others, it may simply mean ensuring that their portfolio supports the lifestyle they want to lead in the most comfortable, stress-free way possible. But no matter what your goals are, one thing remains clear: the most powerful investments are those that allow you to live a life of purpose and peace. These investments help you grow wealth over time, but more importantly, they ensure that your wealth is used to fulfill your vision and support the life you want to create. Think of money as the tool that empowers you to create the life you want, not the end goal itself. Align your investments with the life you envision, and let that vision guide you through every investment decision you make. As we wrap up this discussion on where to invest your money after retirement for high returns, take a moment to reflect. You've heard about diversification, real estate stocks, and the power of patience. But most importantly, I hope you've heard the message about the importance of aligning your wealth with your purpose. Investing isn't just about the returns. It's about creating a life that's aligned with who you are, what you believe in, and what you want to leave behind. The most successful investors aren't those who have the most money, but those who live with the most purpose and integrity. In the end, wealth isn't just about numbers. It's about freedom, legacy, and peace of minds. As you move forward in your retirement years, I urge you to make decisions based on your values, your vision, and the life you want to lead. When you do, you'll find that the wealth you've built over the years will become a tool that brings you more than just financial returns. It will bring you true fulfillment, purpose, and peace. Take your time. Be thoughtful in your decisions. Stay patient, and always invest in a way that aligns with your long-term vision. You've worked hard for this moment, and now it's time to let your money work hard for you, for your peace of mind, your future, and the life you truly want to create. May your investments not only lead to greater wealth, but to a life of greater freedom, fulfillment, and purpose. 2. Fast final thoughts. 1. Align your investments with your purposes. Money should be a tool for creating the life you want. 2. Invest with patience. The best returns come over time. 3. Stay true to your values. Let your money work for what matters most to you. 4. Create a legacy that's bigger than money. 5. Live with purpose. Wealth is about more than just financial gain. It's about fulfillment and peace.